find it interesting that if you ask a very experienced panel like this why they would do acquisitions, or an audience like this, one of the answers you'll never hear is financial engineering. And yet, if you look critically at a lot of the acquisitions that go on, you can certainly say that financial engineering is a part of the rationale. And I'll give an example, and then I'd like to turn this over to the panelists to see if they can comment on this as well. By the way, I don't think financial engineering is necessarily a bad word, although it has a negative connotation. But Alcon Partners, we work primarily as agents for private equity firms. We invest directly, but primarily we work with leveraged buyout firms who buy majority controlling interest in private companies and then grow them through acquisitions. And they add value in many ways, but if you talk to people who are knowledgeable in the private equity industry, one of the things they will tell you that they try to achieve is multiple expansion. Is everybody familiar with the concept of multiple expansion? Anybody here? A $10 million EBITDA business is probably going to sell for a higher multiple than a $2 million EBITDA business. It's been true for many years, and it's true today. So what does that mean if you put together 5 $2 million EBITDA businesses? You can achieve what's called multiple expansion, and that's one example of what might be referred to as financial engineering. Another example of where private equity groups might add value is in creating what might be considered a more optimal balance sheet. Some get accused of using too much debt, but in reality, too much debt or too much equity might be a less than optimal strategy for a business. And hopefully experienced financial investors will come up with an optimal balance sheet mix. I would define it as it's what people always get accused of, or frequently are accused of when they're doing a lot of acquisitions as a rationale for the acquisitions. And you don't see a lot of folks saying, I did this because because I was doing financial engineering. That's the way I would probably define it. I don't know if others would define it differently.
It's a fun way to think about it. I remember looking at new product launches or new concepts, and some of the marketing people would always ask our group, well, tell me what you need, and that's the forecast that I'll give you. So they kind of want to back into it. So instead of giving you what they think they can do, the reach, the market share gains, and so forth, you do the analysis, you play it back. Does it fit certain end present value levels or hurdle rates and so forth that the company has guidelines on? They work it the other way. They kind of talk to their buddies and kind of say, what kind of number do you need? And then that's the forecast they'll give you, so it kind of justifies. It's kind of another way to look at it, too.
But I can give you an example of say, deciding to put debt on the balance sheet so that you could, for the sake of having more debt on the balance sheet so you can make an acquisition, not so much because the acquisition makes sense, but because you think you're under leveraged.
You go buy a company that has next to no growth, growing 2 or 3%. Okay, so if you're not growing top line, we're going to get earnings. You're going to have to obviously cut expenses, be more efficient, and squeeze out additional profitability. So maybe you could move a company that's doing $2 million EBITDA, now it's doing $2.2 million EBITDA. You just move it 10%. So to me, if financial engineering, the best way to see that is that, okay, you come in, you are a buyer, okay, the company's not growing. You basically say, hey, I could buy it for 3.5 times, 4 times. You get the seller to sell it to you for a very low multiple, all right? You go out to the banks and say, hey, I want to buy this company for 4 times, and I could borrow 3 times in borrowings. So I only need to come up with 1 turn of equity. So in that case, all of a sudden, obviously, you have only, you say the company's doing $2 million in EBITDA, you're buying for $8 million, you borrow 6, you put in $2 million, okay? Now all of a sudden, you have leverage on the business, obviously you got to pay the debt. But if you could grow the top line, maybe still about 5%, and continue to be more efficient, maybe this existing manager or owner really did not see some of the operational efficiencies, better sourcing, whatever that may be, you could then squeeze the thing now to $2.5 million of EBITDA. All right? Down the road, you're able to sell it for 5 times. You just sold it for $12.5 million of assuming you pay no debt off, you just paid off $6 million of debt. Guess what? You just netted yourself $6.5 million on a $2 million investment. Pretty good. That's financial engineering in a nutshell.